we've hit the tipping point of online marketing. And then we have this huge infrastructure of businesses that came of age at a time when none of that existed. So I hate to say that there's a lot of low-hanging fruit out there. It's hard to do. It's hard to implement. But for the right people that are ready to take it on, it will be the investment opportunity of our lifetime.
Money can be complicated. Let a nerd help you. We're here to demystify the complex nature of money by getting you answers from financial nerds and whiz kids. Welcome to Ask the Money Nerds, a weekly segment of the Wealth Labs podcast where we answer your most pressing money questions.
Hi everyone, this is Garrett Gunderson with Ask the Money Nerds. And are you wondering where to allocate your money? Where can you invest right now? Are publicly traded companies like the stock market, mutual funds heavily overvalued? Yes. Are there better opportunities out there? Yes, absolutely. And there's the big three that are going to help people own and control the future when it comes to their money. And I'm going to talk about the number one thing today because we got in a question on Ask the Money Nerds. It was from Chris, and he says, for starters, I'm in love with your podcast. I've listened to all of them countless times over. This is a person I love. I want to answer all his questions many times over. So the past several months, he says, you've helped me understand the concept of always paying interest. Pay yourself first, and loads of other, wealth areas. My question to you is, you've been talking a lot lately about businesses slowly becoming available at a lower cost because of economic downturn we find ourselves in. It is early. We're not seeing a ton of that, but I'm bringing the expert that can tell you what's really going on there. I can't wait to introduce him and tell you some of the things that have happened since I've met him. So where should I be looking to find these businesses given they align with my core values? Outside of just having personal connections and keeping my ear to the ground, is there somewhere to look for these business opportunities? Thank you so much for what you do. Has changed my life. All right. So I'm bringing on Walker Dybel. Did I say your last name right, Dybel?
That's right, Garrett. Yes.
I thought it was. I just making sure,
Yeah.
Like I just call you Walker because you picked me up in your car when I went and spoke in St. Louis, and you said, dude, are you a life insurance salesman? Because you read What Would the Rockefellers Do? And I was like, well, I sold it till 2005, so I guess so, but not anymore. And I mean,
I warmed you up before I asked.
Fair question. I mean, you picked me up. I had no choice but to ride to the place I was speaking at, and we became friends. You came out to one of my workshops, and honestly, I don't know how many copies of your book I bought, but they got handed out pretty quickly. And one of the first people I handed the book to is now profiting $40,000 a month from a business he acquired 18 months ago. He then had his brother buy a business because he was going to be in a company that Warren Buffett bought, and he saw the writing on the wall that he was going to get paid less or get fired. And so he actually got to move from some little town in Wyoming that you've never heard of and move to Hawaii. And his business is profitable and got him a great place where he can see the water from his house. So that's just one person. And he just keeps sharing it with person after person. So he gave away all the books that I had. And now I have to just have people who get it on their own. But you wrote a book called Buy, Then Build around acquisition entrepreneurship. And I am telling people buying small private businesses with $2 million of revenue or less is going to be one of the crowning ways to create cash flow, to have a little bit more influence over your money, and to get bargains where these highly appreciated stocks are at huge price earnings ratios, huge multiples that we would never consider buying with a small business. And you're talking about how you can do this with the same small down payment as a mortgage for many people. So Walker, I know you do a million things. I was on Amazon Prime and I saw your name for something you produced on a documentary. I'm like, dude, talk about a serial entrepreneur, buying then building. I don't know how many businesses you own at this point, but I think you were just having a child when I saw you first. And I'm like, hopefully you're spending some time at home.
That's right. I've got 3 kids now, and I'm down to 3 businesses. I had an exit in October.
New kid, one last business. Kid, one
right.
last business.
That's about right. I mean, there's so much to unpack with what you just said, Garrett. Like basically, what I want to hit home is, if you just start with the baby boomers alone, right? There's $10 trillion in business value that needs to change hands. Okay, and on January,
trillion in business value.
10 trillion, yeah. And it comes down to, there's like 12 million businesses, and it comes down to about 420,000 companies that need to transact every year for the next 10. Now, if you look at the middle market, which is sort of like, 25 million and up, it's only about like, 2,000 to 3,000 companies a year. So you're talking about like healthy 400,000 companies looking to transition. Now, in January 1st of 2018, the SBA came out and Small Business Administration came out and said, listen, it's easy to get a cash flow based loan on these middle market businesses, these like $50 million transactions. And when I say cash flow based loan, what I mean is a loan for an acquisition based only on the cash flow and not on the assets of a business. Okay. And on January 1st, 2018, they came out and said, we're going to offer cash flow based loans on smaller companies under $5 million in transaction value. So,
which is 98% of companies.
That's about right. Yeah, that's about right. It's something like that. No, 96%.
Or less than $1 million, right?
Yeah, that's right. So so then you go from, there's like 4% of companies are exceed $1 million in revenue, right? And so the concept here is that there's like 400 and, call it 18,000 companies that need to transfer. And Garrett, we're talking about 45% of the US economic engine lives with the baby boomers right now, and it needs to transfer, okay? A lot of these businesses found product market fit and sustainability during a time when the internet didn't exist. And so simply the fact that there's a whole nother, business asset class out there is proof that, we've hit the tipping point of online marketing. And then we have this huge infrastructure of businesses that came of age at a time when none of that existed. So I hate to say that there's a lot of low-hanging fruit out there. It's hard to do. It's hard to implement. But for the right people that are ready to take it on, it will be the investment opportunity of our lifetime.
All right. So it's the investment opportunity of our lifetime. How does someone go about finding a business? How do they go about making it profitable and they acquire it? And what are the mistakes? So I'm giving you a 3-question preview. Pick your favorite of the 3, then we'll tackle the next 2.
Okay. In no order specifically, let's talk about how do you find these companies, okay? Let's go with the biggest mistakes. They're actually intertwined, okay? The thing is that 9 out of 10 people that start looking for a business to buy are never actually going to pull the trigger on anything, okay? It's a crazy statistic. It parallels that of startups, right? And I think it has mostly to do with mindset. In other words, if you are an investor and you're looking at, a startup business and they sort of come out and pitch you, right? It's like, here's my slides, here's why you should invest in me, here's why you should give me, your money. And a lot of that kind of transfers to, and when you're making, stock picks or anything like that, it's this sort of like, sell me on the opportunity and then I'll spend my money. A lot of times, first-time buyers have the same kind of mentality when they go out looking for a business. They sort of sit back, put their feet up on the desk, and they're like, all right, why should I buy your company, right? And the concept is actually reversed, right? You need to pretend it's an interview that you are the CEO you're interviewing for the CEO job, okay? Like someone who grew their business from scratch. It's their baby. It probably put their kids through college or, has basically it's the biggest asset that they own. They don't, the money needs to make sense, but they're going to make a decision on all of the qualitative things that come along, okay? So the first is sell yourself, don't look to be sold, okay? Number 2 is work with a sense of urgency. A lot of people are like, hey, this will happen when it happens. I'm looking for that, gold nugget or whatever. And they're not working with a sense of urgency. And if you set a goal for yourself of like, hey, I'm going to buy a business in the next 6 months, that's really aggressive. That means you need to find that company in the next 90 days and you need to start the closing process, okay? And if you're working with that sense of urgency, you will find your opportunity. You won't sit around and wait for, that absolute perfect marriage, right? Like when we're all like children, we think there's one person out there for us, right? By the time we're 40, we realize, there's probably a couple dozen people that would have worked.
Your poor wife, dude. I'm a premier romantic and a hopeless romantic. And so I believe, I met the one person that could tolerate my BS and still love me somehow.
That's true for you, but for most people, right? It's sort of a life decision that happens at a certain time. You're a little, you're a little 1%.
There are 8 million people out there, so yeah.
And so the thing is there's a lot of relationships that could work, right? There's a lot of businesses that make a lot of sense, right? And the thing is understanding the underlying drivers that are important to you and the growth opportunity that is right for you and what you bring to the business is the little thing that makes the big difference, okay? In other words, most people will look at a business opportunity or an acquisition opportunity as sort of like what's on the menu, right? And
if it's a great business, other people are probably going to buy for it. So that's treating like an interview, like bringing the best you have to the table, critical.
They go into the restaurant not knowing if they want chicken or steak or pasta, or if they're a vegetarian, or they don't even know what they're looking for, right? So finding out what it is that you bring to the table as a CEO is the thing that's going to help you identify what's the right business for you.
And what kind of things for people that have never owned a business before would they need to prepare for? How complicated in your mind is it for someone who's never owned a business to run a business? Like, is there things that you would do if you'd never owned a business to do this right? Were there resources that you would read or people that you would seek out?
Yeah. I mean, saying you're going to buy a business is sort of like saying I'm going to go get a job. Like there's so many different types of companies that it's impossible to answer the question. What I would say is that, you know, I make money a few different ways. One of the things I do is I work as a business broker for online businesses. And I think that online businesses have a high degree of transferability. So they're easy to buy and they're easy to sell. And it's also kind of like business light. In other words, they tend to not have 35 employees, at a manufacturing location with all kinds of capital equipment and things that can go wrong. And so the more people you add and the more pieces of equipment you add, the more increased complexity there is, right? And so there's kind of there's just kind of let me answer the question this way. Search funds have become very popular in MBA programs, right? It's the number one, entrepreneurship through acquisition is the number one elective MBA class at every single school in which it's taught. But it's only taught at 11 schools, okay? And the concept is search funds. So MBA students basically getting financed by these, institutional capital firms or angel investors to go out and find a business and buy it and run it, okay? And the thing is I've often questioned, is that a good idea for a newly minted MBA to run out and buy a company, right? And the thing is that I thought I was ready when I graduated with my MBA. What happened was, I found the private markets. They're opaque, they're fragmented. It takes a while to figure it out. And so I spent a couple of years looking, but during that time I had a couple of jobs. And Garrett, I just want to tell you, I learned more, just in my mid-20s, out there doing it, actually trying to sell things, actually trying to, manage teams of people, actually trying to, run production, that I got to actually break things on other people's dimes before I ran out and bought a business.
So working for the type of business that you might look to, acquire. So going back to your menu analogy, chicken, steak, vegetarian, once you identify this is what I'm going to acquire, then you uncover your investor DNA, how you understand how you would run that, learn from those people. Even if you're paid less than what you want, be paid with that education, be paid with that information, be paid with that insight. And then, especially if you were going to work for somewhere that wanted to sell in 3 years, go ahead and put yourself right into that purchase.
That's right. So I think understanding what you bring to the table, working with a sense of urgency, and really understanding that, you're applying to be the CEO of this company are sort of the three things that make the big difference in initiating a search and actually closing on something.
Yeah. So the mistake would be not knowing what you're looking for.
Yep.
Going into it before you're ready. Not knowing what would make you ready or who to learn from.
Yep.
And then, just not knowing where to search would be another mistake. Jumping into something too early would be another mistake. Trying to do too much alone.
Yeah, so when you get into I would say once you actually get to LOI, what letter of intent, and you could put in an offer that's accepted, the mistakes that happen after that are, it's sort of do your due diligence. It's kind of amazing to me how many people are sort of laissez-faire about their diligence, and what that means is it translates.
We're already bought into the idea before we've done the analysis. I already know I'm going to buy it, so I stop looking at due diligence because I'm convinced.
That's it. And
I'm just speaking from my experience of acquiring a business. Just saying.
Yeah. No. That's it. And the thing is that this is how it actually surfaces. The day before closing or the week before closing, it's I don't know. I just have cold feet. I just feel like I can't close it for some reason. I don't know. I'm not comfortable. Well, you're not comfortable because you didn't do your diligence, right? If you actually jump in and do financial and legal and operational diligence, you're going to be very comfortable. Now, there's always a leap of faith. It's always a little nerve-wracking, when you're taking out a big loan to buy something that its destiny is dependent on your ability to actually create the future you're after. But the thing is like, do your diligence and just prep, right? And the only other thing that I would say is, it's not exactly a mistake, but it leads to one, which is a lot of first-time buyers really don't understand that most sellers are not evil by nature. In other words, they think that they're trying to dodge some kind of bullet, or like, oh, if it's so good, how come they're selling, right? And the thing is that like, probably a percentage of people are bad people, okay? That leaves 99%, okay? When you go to sell a business, it's a natural part of the life cycle of entrepreneurship, okay? Like, number one, we build something of value, okay? And it's a value, and then, we get it to a certain point, doing what we know what to do, and then it sort of starts to flatten out. And as entrepreneurs, we all kind of have shiny object syndrome to some degree. And so you get sort of on to the next thing, and like you start, planting seeds, and then you're like, wait a minute, I can do this, but what I really need to do is sell this company first so that I can focus on the next thing, right? And so you've created something of value, and it's time to sell, right? It's time to exit. It's time to sell it to someone to take it to the next level. At the same time, if you look at that growth from like 0 to 1, if you will, when you're starting a business from scratch, and compare it to, buying a company with, if you use a lot of leverage, put a small down payment in, the curve is very parallel, right? Like, you're building that equity in the company almost at the same rate, especially if you can grow it, right? And so it's just a part of the natural life cycle. And then once you have run your course, it's time for you to sell as well.
So yeah, and that's part of the acquisition entrepreneurship goldmine, is if you have new insight, new energy, a new person, there's definitely some break off in that, but there's also a possibility for breakthrough, for bringing that, energy to it. So where do people find businesses? Like, you're a business broker. Like, I pretty much just tell people business brokers. I mean, do you have a better answer than that?
No, I think that's the best place to go, frankly. Look, there's a lot of attention. Once you break into like, okay, what is acquisition entrepreneurship and how do I do it? You'll see there's a lot of noise around proprietary deal flow. Ooh, what that means is go out and talk to everyone you know, okay? And try to dig up a deal, okay? The thing is look, I spent a lot of time trying to do that myself. Off market deals happen all the time, okay? It happens. But number one, every business owner who hasn't talked to a business broker yet or gotten a valuation, or business broker, by the way, can be called intermediary, investment banker, M&A advisor, it doesn't matter, okay? If they haven't talked to someone and sort of gotten a valuation and understand the process, everyone knows that their business is worth like 20 times EBITDA, okay? And, that's not how the private markets work. But
and EBITDA, for those that haven't heard the term, you hear it a lot, especially in this type of, transaction. It's earnings before interest and depreciation and amortization. So basically, it's looking at a more clear picture of what the profitability or revenue is after certain expenses are taken out, or certain, things have minimized. So, yeah.
Indeed. It's an attempt to neutralize earnings independent of management decisions. Like if this business is a box, like how much cash does the box generate that I can use, right? Like that's the concept. So 20 times EBITDA would be okay for a publicly traded firm with, $1 billion in revenue.
Yeah.
Or, $1 million business, you're probably looking somewhere between, 2.5 times and 4 times, right? Depending on 10
to 20% of what they're, excited about.
Yeah. So,
another reason why I'm excited for small businesses, because I'd rather do 2.5 than 20. Like, if I'm buying a small piece of a publicly traded company because I own a share, well, I'm buying that, and I'm basically saying it's worth 20 times more than what I'm paying for it, essentially, right? It's like a future potential and where it's going to go to. Or if I'm buying this other business, I'm like, I'm buying it today for 2.5 times what the EBITDA is, which is different than even revenue. And so it's just there's a lot more upside potential or immediate cash flow, which most stocks don't produce a lot of cash flow, but a private business could. I've interviewed some of your clients and, that made it profitable after 30 days and had a really good stream of cash flow after 90 days or 180 days. So, and part of it is they had expertise in that arena, and they focused on some things that the other owner just didn't know about, because a lot of these entrepreneurs are good with ideas and starting something, not good with managing it and the details behind it. So, and what I find is a lot of people that aren't business owners are very detail oriented. They usually work in an organization rather than start something. So, in the Myers-Briggs world, like an SJ, like a methodical, less likely to start a business, but maybe the perfect candidate to buy a business and improve everything in that business, right? So just as an idea there.
This morning I was talking with one of the members of the acquisition lab that I run, and she was asking about, we were talking about, the book Traction. Gino Wickman, right? Yep. And Gino Wickman has the visionary integrator dynamic. And what I want to tell you is I read that while I was CEO of a book printing company. Okay. And I was like, I don't need I'm the visionary and the integrator. I can't afford a visionary walking around, and I also can't afford to leave the business and just walk around being the visionary. Right. So I had to be both. And so what I came up with before I read the book was actually revenue generator or profit maximizer. Okay. And I feel like if you're in not a high growth business, or you're in more of a mature business or something like that, I feel like you kind of resonate in one of the two places. And then along the way, I've sort of realized that in high growth companies, the visionary integrator roles really make a lot of sense. And so I came up with this idea that they actually overlap with each other, and you end up with quadrants, right? And it's sort of where do you fall, and what's the right business opportunity for you? So to your point, there's a ton of people out there that just want to manage a going concern. And, if you take this sort of 3x, multiple of EBITDA kind of earnings of valuation that we're talking about, Garrett, what you're talking about is, putting 10% down on a business, getting a 90% loan on the business, and then off of the price, you're making a 30% return. Okay. And then you cut that in half if you maximize the loan, right? So you're still making 15% on your money right away. Now, the argument against that is yeah, Walker, that's great, but I'm putting my time in, right? And so I should be making a salary as well. Yeah, you are, right? I mean, this is your salary, but the point is you also get the asset. So you're working your cash flow statement, you're working your personal income statement, and you're working your balance sheet simultaneously.
Yeah, you have more control over the outcome of your income. You have more influence. And I think this notion of passive investing, where we just give people our money and then money comes in every month, is a faulty notion. The reality is, the more active we are up front to buy an asset that can continue to generate revenue, the more passive it becomes over time versus just watching our money pass us by. And this is the travesty for humanity, is that we've been taught, trained, and educated, hand your money over, wait for 30 years and it's all going to work out. Well, 95% of the time it does not work out. So I like this because you can look at the predictability of the business, the financials, how long it's been around. And, I'm thinking of two people that weren't business owners that read your book and bought businesses, and they're doing great. It doesn't mean there isn't trouble at times and they don't have to get involved. And there isn't yes, it requires effort. When we think there's something for nothing, we're being robbed of our livelihood. It doesn't exist. There isn't mailbox money for 99% of the people or 99% of the time. Even if you're part of the Lucky Sperm Club, meaning you were born into the family, you still got to behave a certain way if you want to still get it. If you're going to win the lottery, you're one in however many people that actually win it. The rest of the suckers are just giving their money away. And if you marry into it, that's probably the hardest work there ever has been, to be able to get money, because now you got to fake that you love someone, and that's a pretty tough thing to do. So I look at this as a much better alternative here, right? So Walker, thanks for answering those questions. I got to have you back on to Ask the Money Nerds, because we did get more questions around this. But I will say, I don't endorse a lot of books, because first off, I only endorse books that I read. And what most authors do is say, hey, I want you to endorse my book. Can you have it to me by Thursday? And it's Tuesday. And I'm like, well, I can't. But you actually got me the book, got it to me on time. I read every page of the book, and I personally wrote the endorsement. Now, I don't know if you massaged it or made it better, but I did write the endorsement that went into the book. And then I endorsed it so much that I bought a bunch of copies. We handed it out to clients, and I consistently introduced Walker to people and connect them to my team, because this is an important part of our future when it comes to investing. And a lot of the financial people out there don't get paid on a transaction for you to buy a private business, including my firm. We're not paid on that. I don't care. I'm here to make sure we're doing the right things so that people can get ahead. because there's going to be a major transfer of wealth, and this is one of the 3 avenues that transfer happens. Make sure you're on the right side of that transfer. You can help out your employees, you can help out, the people that are your customers, rather than just watch your money dissipate when you're in an overinflated stock market that has no accountability. So, Walker, any final words before I bring you back on and interview you again?
I would just say that this is entrepreneurship. It's not easy. To your point, it's active investing. Okay, so you can be active and uninvested, like at your job, or you can be invested in passive and enjoy your $1 a month return, or you can combine them together and create something that is truly special and built around.
Well, thanks, man. I will talk to you again soon.
Thanks, Garrett.
Want to continue the path to be a better investor? Make sure that you're not losing money and taking too much risk? Well, click here and learn about strengths vesting.